Hello and welcome to the Monday Futures Market Outlook for June 14th, 2010. This is Patrick Srezna. For those of you that have not had an opportunity to try out eminisource.com, try a 30-day complimentary membership, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. Essentially now that we've had this rally for several months above this 80-week moving average, we want to look at all the different scenarios of how this market can play out. If we started here this second quarter weakness on the downside of the market, and if we, let's say, spend the second and third quarter consolidating and holding the lows somewhere above the 950 to 1000 level, there's a number of different patterns that could play on how we get to that end result. But so long as the market holds in at or above those levels, then the market can very easily turn bullish at the end of the year and have a sustained rally up to 1200 or higher on the S&P. But the reason we maintain our bearish bias, and the only way that we would turn it bullish, is this very scenario. We maintain the bearish bias because this entire rally that we've seen up until this moment has been nothing but a Fibonacci retracement of the entire bear market. And at this point and at this juncture, we cannot technically rule out the possibility that this is one big wedge on the upside that is going to technically break down and bring new waves of selling. Now, we do not favor this scenario, but at this point, technically, it cannot be ruled out. When we take a closer look at the S&P 500 using the daily charts on the E-mini futures contract, we were talking how critical that 1040, 1050 focal point on the downside was. Last week we were sort of at the edge of a cliff, and if the bears took that market below that level, it opened the window for an accelerated sell-off down to 1020 or even 1000 or lower on the S&P. But the bulls did a very good job digging in and holding at this point, and we've now seen some strong counter rallying on the upside, especially the end of day Friday move. Essentially at this point, we're following through on Monday morning, so we're probably going to see a good test of this 1100 to 1110 on the upside. At this point, with this short-term bottom in place, it's quite likely that we're going to see some sort of a retracement that pushes maybe even for the remainder of the week up into this higher zone. In the bigger picture, we don't have a lot of faith in the sustainability of this rally, but at this point at least, the sell signals that we were fearing last week have at least subsided. Just to review our key points, our thesis since January 2008 continues to be that we're in a secular bear market, and we will not change this until we see the extent of the sell cycle in this pullback that we're currently in. The bulls have dug in and held that 1040 support, so the short-term sell window is closed. If that was a short-term double bottom that we saw, then a retracement all the way up into the 1100 to 1140 area is expected at this stage. And even if the market wants to rally in the short term, we continue to be skeptical of its sustainability into the summer. Next year, I want to take a look at the NASDAQ 100 using the E-mini futures contracts. We more or less are seeing a similar situation where we have some short-term lows come in all along the bottoms there. We tightened up that focal point to 1740 to 1770 area to reflect those short-term bottoms. At this stage, the NASDAQ could work its way all the way back up to even 1950 on the upside on the short term. But again, we're skeptical of its longer-term sustainability. Next here, I want to take a look at the US dollar index futures, and with that bullish breakout we saw the other week, we were having a target on the upside up into as high as the 90 level, but we completed a move to the 89 area with a doji star at the top, and now a reversal. We're also seeing that rally following through today in the euro, which at least on the short term has put in a top up here. So the dollar will probably consolidate now that we're breaking trend line. Dollar could work its way all the way down towards the 85.50 to 86 level, and we're watching where these short-term support lines and how long this lasts, because if the euro finishes its squeeze higher and finds some overhead resistance, that distribution can begin again and see the dollar reverse back on the upside. So we're going to watch where the short-term bottoms come in here. Next year, I want to take a look at gold futures contracts, and we're seeing that the 1245 to 1255 act as some pretty formidable overhead resistance. The question becomes, is this a double top that we're seeing up here? Way too early to make any call like that. There's no violation of any trend lines, nor is there any indication that this is actually topped out here. But so if we here have any technical breakdown below the 1210 area, at that stage we would visit the idea that at least some sort of a top has been put in here. But if we see support lines holding, especially on a few throwbacks in the market, we certainly will continue to look at the for moves to continue in the trend that's been in place, which would in this case see us push as high as the 1275 to 1300 level. So at this point, if we see the gold holding in, especially while the market is rallying a bit, if gold doesn't find a motive to sell off, then eventually we'll be looking for this breakout on the upside. But all this scenario only is valid so long as gold's holding above 1210. Next, I want to take a look at the mini crude oil futures contracts, and we continue to see this market repairing itself slightly on the upside. We continue to find overhead resistance at the 75-76 level, but overall, if this is one big wedging formation on the upside, we could still see even oil have a pop that can even go temporarily as high as $80 on the upside. But in the end, at some point, wherever oil tops out, we're anticipating it to roll over again and start a new sell cycle. Finally, I want to look at the 10-year Treasury no futures contracts. Essentially, we've had a sustained rally all the way up into that 122 to 122.5 area on the upside. Subsequently, a profit-taking cycle came in right at a critical level where the highs came in February. The lows have now held here in June. And so essentially, we're now looking at a Treasury note that's consolidating sideways. If the market is on the short term going to rally, and again, that's we're applying the intermarket analysis here. So if we see sustained market rallying while the U.S. Dollar continues to see downwards pressure, then the Treasury notes can do a little bit more selling in what would be a zigzag consolidation. And if we see a technical breakdown of this trend line, we could see us not only come back to retest that 18.5 to 19 level, but you can even see short-term moves that can even go down as low as the 117.5. So again, we're going to be watching where this is going at this level. That was your Monday Futures Market Outlook. Thank you for joining us.